Hello, this is Sarah Snellcook, Editor-in-Chief of Credit Union Times. On June 29th, the NCUA approved its final plan for the voluntary prepayments. This program is to prepay assessments for the Corporate Credit Union Stabilization Fund. The original proposal included a range of funds the NCUA wanted to raise somewhere between $300 million and $1.5 billion. However, in the final regulation, NCUA hit a hard, fast cap, minimum and maximum, of $500 million. They also lowered the minimum participation amount to allow more credit unions to participate. The two national trade associations took very different views of this. CUNA's Deputy General Counsel Mary Dunn had this to say about the program.
What we're hearing from a number of credit unions and some leagues is that they appreciate NCUA's efforts to consider a plan under which they would be able to reduce their assessments for this year, but they're concerned that the size of the participation amount, the $500 million that NCUA wants to get total in order to make this program work, they're concerned that it's not really large enough. Because if it were larger, say $1 billion, which is what CUNA had suggested, the amount of the decrease in this year's assessment would be a lot more. In other words, credit unions would end up paying less of an assessment if there's more participation in the program. So we're encouraged that NCUA considered putting this on the table and did go forward with it, but there's also concern and some disappointment that the size of the program may not be as meaningful as credit unions were hoping it would be.
NAFCU General Counsel Carrie Hunt offered this.
NAFCU believes that credit unions should look at this program carefully and make the decision on their own whether it's something that they want to participate in or not. NCUA has said that they expect if they get a minimum participation of $500 million, that credit unions potentially could see a reduction in their assessments for 2011 by about 6 basis points. And certainly that is excellent that NCUA is looking at ways to mitigate costs for credit unions. Obviously, though, when credit unions are looking as to whether or not they want to participate, they'll have to take into account the fact that those funds will be tied up for years to come and the opportunity cost for participation.
And credit union executives had a wide variety of reactions, from participating to pondering to, as Department of Commerce Federal Credit Union CEO Evan Clark said, perplexed.
I don't know about other CEOs, but I'm a little perplexed by the changes to the voluntary assessment. When the voluntary assessment was going to be for up to 36 basis points and they were going to raise up to $1.5 billion, and they could potentially drop my assessment from 25 basis points to 13 basis points, it made a lot of sense to me. But now we're going to raise maybe $500 million and we're going to drop the assessment by 5 or 6 basis points, and that could potentially be an ROA change of 3 or 4 basis points. And we also go from 36 basis points to 42. It tells me maybe there's some lukewarm demand for it, and it's not as compelling. So what do I think of it? I'm very perplexed by it. I don't know whether we're going to voluntarily participate or not, because it's just changed the whole dynamics of it, and I don't know what to think. I'm very perplexed.
Jan Roche, CEO of State Department Federal Credit Union, said that her credit union recognized the emotional ties between the corporate stabilization and the NCUA's involvement, but her credit union will be taking a hard look at the real business decision.
This has become a very emotional issue. Anything that has to do with NCUA corporate assessments is being driven from a very emotional place. You know, we at SDFCU are not happy and are frustrated with paying the assessments as well, but we're going to come at this decision from cost benefit and look at the financial analysis behind whether or not this is a good investment, the right investment to make in this interest rate environment. And so we're hoping other...
Issa Stephan, CEO of First Financial in New Jersey, said that he just doesn't have enough information right now.
Until we get more information, we're really not sure. But as of today, with what the information we have, if I have to make a decision, it would be not to participate. Several reasons. First, everything is estimate. Nobody's coming and say, okay, if we're going to put this money, they're going to save us 8 basis points or 10 basis points in the assessment. All they're saying, you know, if you give us that much money, we think we're gonna save you that. You know, it's like going to the market. You know, I can go in a stock and, you know, take that risk. The other thing like you said, they don't address the interest rate. How much they're gonna pay is basically it's a zero interest rate loan. Yet they want us to have a policy on interest risk management. So I think that's gonna be in violation of their interest risk management, because why would you give a loan of a 0% and you don't know what interest rate is gonna do in the next 2 years?
CUNA Chief Economist Bill Hampel explains some of the details as he understands them.
From the point of view of credit unions, if all credit unions were to participate at 6.5 basis points, that would in essence generate the $500 million. And so this year all credit unions would send 25 basis points to the NCUA. 6.5 of that would be in a prepayment, and the other 18.5 of that would be in the assessment for this year. However, it's kind of likely that not all credit unions will participate. So another way to look at it is if half of credit unions participate at 13 basis points, that also would generate the $500 million, which means that all credit unions would have an assessment of 18.5 basis points this year. Those participating credit unions would send more cash than that, but then they would be able to use that prepayment to reduce the amount of cash they need to send in 2013.
Still, Isa Stefan wondered if NCUA had other motive.
The question is, why did they go from 300 to 500 million? It seems really more to address a liquidity issue than really what credit unions, you know.
However, SRP Federal Credit Union CEO Ed Templeton said his credit union plans to participate.
And we plan to participate right now. And it's sort of I use the word divisive, but it really isn't argumentative divisive. You have two schools of thought on it. You got the school of thought, primarily the credit unions that have a lot of capital, have good earnings. It seems to be a non-event to them, almost they're looking at the dollar and cents, what's it really going to do for me. And you got credit unions on the other end of the spectrum who have weak capital. Our capital is really not weak, but we're hovering right around 8. So prepay assessment opportunity for us could be the difference in having capital of 798 at the end of the year versus 803 at the end of the year. The optics on that are huge, even though the absolute numbers aren't very much. So I really think it's what's it going to do for your credit union, what's it going to do for other credit unions. We again are going to support it. I think it's a good thing, and I'd like to commend the NCUA for at least getting out of the box, thinking outside the bounds, and trying to find ways out of this situation that we're in, and I think it's a good thing overall.
Given that NCUA issued its final plan, Jan Roche said she figures they must have some traction.
They must have gotten a lot of interest coming back in the comment letters, and that's why they felt like they could increase the amount and the people that would want to participate. So it sounds like I think they're going to get what they need, and we're going to have a prepayment that's going to be successful.
Thank you for sticking with us today through our presentation on the prepayment program from the NCUA. This is Sarah Snell Cook signing off.